Hello and welcome back. All right. Believe it or not, we're getting near the end of the Value of Growth lecture series, episode 31. This has been great. Almost a year. Started last just May, just after coming back from the Berkshire Hathaway annual meeting. One of my former students challenged me to put some videos up, and here we are almost a year later, 31 episodes. It's been a lot of fun. All right, we're going to have two more formal lectures on growth this week and the next video, which I think will be next week. Then that's it. But I'm going to do, I think it's four supplementary videos, talk a little bit about compounders, a phrase that gets thrown around a lot. I'm going to use the tools to do that. I'm going to talk a little bit about how to apply these tools to private equity. I think that'll be fun. I'm going to do a case study on how to use the model. I've gotten a fair amount of feedback on LinkedIn that people are very intrigued by the tools, but would like a bit more instruction on how to use them. So I will walk through a tutorial how to use them. I'll use Chipotle as a model. And then I'm going to do a historical evaluation of Cap Cities, ultimately Cap Cities ABC, and then they got sold to Disney. Dan Murphy and Tom Murphy and Dan Burke ran a hell of a company for a long time. And I'm going to use these tools to show kind of what they did. All right. So along the way, I'll probably think up some more videos. All right. So we're almost done. Now, today, what I want to do is use the 5-stage growth model that I introduced in the last video to build up, to really model a company, and then show how the pieces come together. And you can use the tools to think about how the stock market works, frankly, from a long duration perspective. At the end, also give a quick example of a company not growing that fast. I was thinking of McDonald's when I started to think about it. Grows 3 or 4% a year, and I want to show you how you can use these same tools in a slower growing company. It's essentially the same, although it's kind of an interesting visual difference. All right, I have been thinking about this challenge of modeling a company for a very long time. I had the great opportunity, in the early part of 1997 to co-author a report with Michael Mauboussin. I had been working at First Boston when he and I got to know each other. We did some interesting stuff together. And then we published this report. Graciously, he put my name on it, even though I was no longer at First Boston. You'll see from the email on the far right, I had moved over to Robertson Stephens. So he was very gracious to include me in this research report. And Michael and I were both debating how you thought about the duration of competitive advantage, the duration of excess returns. And he had coined a phrase, the competitive advantage period, which, as the name implies, that's the time a company has a competitive advantage. And so we were modeling it. I've always been somewhat of a visual thinker. And we want to kind of think about a way we can visualize all of this. And what I want to show you is, let's see, it's about a 27-year, 28-year, I guess, voyage, journey to figure this out. So I want to walk you through it. It's kind of fun. All right, so here are the three main charts, main figures we had in the competitive advantage period report that we wrote. The first one, figure 1, is what we call the theoretical decay in excess returns. And the idea is that over time, competitors would enter the market. They'd drive down those competitive returns towards your cost of capital, and the excess returns would go away. So that's kind of theoretical. And then my real contribution to all this was the next chart, which was, and I said to Michael, I said, look, there's always a fade period, but I think the market just fades it, but at some point stops valuing cash flows after a period. So the chart looks a bit more like a trapezoid, I guess, or part of a trapezoid. We have a decay for a while, and then it's not that the competitive advantage goes away, it's that the market stops valuing cash flows after a period of time. And at the time of the report, I really thought that was 25 years. Now, why I thought it was 25 years, I'm not 100% sure. But I've carried that forward, and you'll see that a bit later in this lecture. And then what's interesting is if you think about what happens to a company is that if they go forward in time, and investor. This is really an important insight. I'm going to talk a lot about this today. But the company moves forward in time, and the competitive advantage holds. That shaded area is effectively the excess return for shareholders. So you think about it. So if you go back to the first chart, the area under the curve is excess returns. If you go to the third figure, we call them figures, I call them charts now, and you say that the market's really only forecasting 25 years of a competitive advantage, and then guess what? A year later, investors say, wait a minute, you know what? The competitive advantage still holds at 25 years. That meant that last year, investors should have given the company a 26-year competitive advantage period. This was our thinking at the time. And then that shaded area is the excess return to shareholders. And this became kind of an interesting insight, which was this 27 years ago or whatever it was. All right, pretty cool. Shortly after publishing that, I was at a different firm, as I mentioned. I started to think about this a bit differently. And I said, rather than be kind of linear, it's probably competitive pressures are more shaped like this, which becomes important. I'm starting to introduce curves. And I started to think about, I'm going to go back now to my figure 2. Remember, I said that the market, investors just stop valuing cash flows after a certain period of time. And this has really became my chart, the one I used regularly when I talk to clients. And I would say, look, and in teaching, because I was teaching back then, I would say this is probably a better way to think about it is the return on invested capital fades over time like this. And this became kind of the standard the standard way I thought about it. All right. If you remember, if you're assuming you listen, when I met Jeff Moore, I showed him this chart. Now, this is a replica because I gave him the napkin, but this was essentially what I did is I took his S-curve, that hypergrowth S-curve, sigmoid, and I added my cap charts to it. And that's how I got to this figure, this chart that I did for him. And it was really beginning to look at this being kind of the value of the company. And this is what would happen when they went through hypergrowth. You'd see this huge increase in the value of the company because this chart here would be driven out. And that became kind of the basis of the book. These are the charts from the book. You can see that these really are descendant of this chart. This was really the way I was thinking about it. And this is what we ended up talking about in the book. These curves that kind of fell over, rolled over as time went on. And you see, we adopted this competitive advantage period language in the Gorilla Game, which was kind of fun. After the Gorilla Game got published, I kept thinking about it. I was like, you know what? This is still not where I want it to be because I want to link the chart back to valuation. And so I played with it a bit. And then I realized that another way you could think about this was NOPAT versus your capital charge. Those are true excess returns in cash as opposed to returns. This chart back here really talked about it in the return space. And what you do is if you multiply both items on the left by the invested capital, both top and bottom, keeping the scale and the units correct, you end up with NOPAT and your capital charge. And so EVA, which was the Joel Stern concept, which Michael and I had been exposed to at the time, was the difference between your NOPAT and your capital charge. And then the area under the curve is market value added. That was sort of the original idea. Now, I like this chart. This chart became kind of a staple in my life. And in fact, it was a better chart to apply here because you could see the MVA blows out rather than this chart, which is hard to translate. So this became kind of the new insight that I had. And I used this for a long time, really thought about it. But I realized that I didn't know how to model this. And but I started thinking, well, let's go back one. I didn't know exactly how to model this. So that was something I spent a lot of time on. And so one day I kind of came up with this idea, wait, what if we did the present value of free cash flows? Rather than NOPAT, which is a nominal number each year, let's do the present value of free cash flow. And now all of a sudden, this becomes the enterprise value of the company. And that for me was a pretty important breakthrough. So this is kind of the big breakthrough I had a few years ago, and I started to model it that way. And if you think about it this way, now you have the magnitude of the cash flows, and you have the duration. So we're starting to capture the three drivers of a valuation model, which is magnitude of the cash flows, duration of the cash flows, and then growth of the cash flows, which we'll add in. All right, in 2017, had the opportunity to publish a book with Paul Sonkin. We were thinking about all this as well. Coming out of that book, I had this next insight. What if this was slices of the present value and we kind of tucked them under this curve? So the curve was essentially these slices. Now, I'm hoping that you'll see the connection between these slices and last video where I look at various stages that a company could go through. I'm going to piece this all together in a moment. So this became, post writing that book, this really became the graphic I used. And then I was on a bit of a mission to see if we could actually figure this out, which I've done. And it is the basis of the Value of Growth lecture series. Ultimately, I hope this will be a book called Value of Growth or something like that. All right. Now, here are the 5 stages that we had from last video. I've just done each stage is going to be 5 years rather than 15. Last video, I did each stage for 15 years, just so you could see the kind of impact. And here I'm going to do a stage 1 is 12% growth. Stage 2 is 8% growth. Stage 3 is 4%. This is NOPAT growth. Stage 4 is 0 NOPAT growth. Stage 5 is minus 5%, just sort of going through the cycle of a company. All right, so this was the first one. So stage 1, very similar to what example 1 in the last video, grow NOPAT at 12% a year, discount it back at 8% a year. So we end up with, on the right, annual NOPAT, and then the present value of that annual NOPAT. And this is what it looks graphically. Now, keep in mind, I've kept the scale on both charts the same, so it goes 0 to 30 in the example. All right, so we know from before, when we look at the numbers, right, both numbers grow year over year. So the annual NOPAT growth, those are nominal numbers, and then the present value of those annual NOPATs also grow, which is really important. We talked about it last week. I'm going to talk about it again today. All right, next stage, NOPAT grows at 8%. The discount rate is 8%. We now know that the nominal will grow, but the discount of the present value NOPATs will not grow because we're growing at 8%, discounting back at 8%. All right, third stage is we grow at 4%. In this case, we'll still have annual growth. The annual NOPAT, the nominal, will still grow, but the present value will start to shrink, incrementally start to shrink. The next one is we're going to grow NOPAT at 0 and discount it back at 8. We know now it's going to actually shrink at a faster rate. All right, so we've started to do that. Now, period 5, I just want to talk about period 5 for a moment. I'm going to introduce another concept. And it's somewhat controversial in a sense because it's new and different and people don't necessarily see it, that it's so intuitive. And in fact, Paul Sonkin, my co-author, when I explained this to him a couple of years ago, he really didn't like it at all. He thought, this doesn't make sense. But the more I think about it, and I have been thinking about this forever, the more I think about it, this makes perfect sense to me. So I'm going to deviate the conversation for a moment just to introduce this concept. All right, so here's a question. That is, if you were offered $1,000 in 20 years, so you get paid $1,000 in 20 years, assume no inflation, or assume it's inflation adjusted. So it's $1,000 real, and you're not sure if you're going to get it or not. Reasonably likely, but not for sure. The question is what would you pay for that today? What value would you place on that $1,000? Now, you're not going to pay $1,000 to get $1,000 in 20 years, so we know it's worth less than $1,000. And the question is, what would you pay for it? Well, that exercise of trying to decide what you would pay for it is effectively applying a discount rate to that payment. It's a single payment. There's no coupons along the way. It's a zero coupon bond, essentially. What would you pay for? And whatever you paid for today is essentially a discount rate. You're discounting that cash flow back. That's essentially what you're doing. So you could either say, look, I want a 20% return every year, That's one way. Or you could say, I'm willing to pay $10 for it today, whatever. And you could then impute what the implied return is. And that's what I've done. So I just said, well, what if you wanted 25% a year in terms of your return to make this interesting? Well, then that zero coupon bond today is worth $11.53. So $11.53 is what you pay for it. And if in fact you get the $1,000 in 20 years, you will have earned 25% compounded each year. All right. So it's essentially as if. It's as if you're discounting. This is the insight I want to share. After year 20, I will argue that investors start using a higher discount rate. In other words, after year 20, it's not exactly year 20, but call it 20, for years 20 to 25, they're just not going to place much value on those cash flows. They're so far in the future, there's so much uncertainty, the world could change, blah, blah, blah. I'm just not going to put a lot of value on it. And I think this is what investors effectively do collectively. Now, individual investors may or may not do it, but collectively, I think this is how the market works, is that at some period of time in the future, what you see is that those future cash flows there's not much value to them because there's so much uncertainty. They're so far in the future. It's as if investors are putting a very high discount rate. All right, so for stage 5, I'm going to introduce something called hyperbolic discounting. And hyperbolic discounting is this mechanism where the discount rate effectively starts to increase, call it exponentially, for those 5 years. Now, I had two motivations here. One, I think this is how the market works. And two, I wanted to get rid of the residual value. The problem with the DCF is that we only do a 5-year explicit, generally, maybe a 10-year explicit. But then you take all of those future years and you stuff them into the terminal value. And that terminal value is often 75, 80% of the present value is all stuffed in this terminal value. And I wanted to get rid of that for that reason. So two things I effectively did is push the forecast period, the modeling period, out to 25 years, which, by the way, fit with what my thinking was in the stock market back in '97 when I wrote the Competitive Advantage Period article with Michael. I said it's 25 years. I've always thought it was 25 years. So I started modeling this as 25 years. I want to get rid of the residual value, number one. And number two is I really do think those out year cash flows just don't have much value. People don't place much value. So by using hyperbolic discounting, I do two things. I discount those cash flows far out in the future by a lot, diminishing their impact on the valuation. And I get rid of the terminal value. All right, so this is what it looks like. All right, so now I put all 5 periods together. The last period is negative growth. Go back. It's negative growth plus hyperbolic discounting. All right, now I'm going to do is remember I set this up so the axis in both charts is identical, just so they match. But I'm going to do is take the chart on the right, and I'm just going to change the scale. So the chart on the right here is the chart on the left. It's identical. I copied it in PowerPoint. They're the same chart. And then what I did is change the scale of the chart on the left. Rather than go from 0 to 30, I go from 0 to 12, just so you could see the visuals. All right, I'm going to work with that. Now, this is the same chart on the right. This is the same chart just blown up. All right, so let's go look at what this does. Now, again, I want to come back to this point because I think this is really cool. Other people seem less impressed than I do, but whatever. This is a visual DCF. I think that's really cool. We do these DCFs. Well, let's visualize it. And I'm going to have a lot of fun with the visualization momentarily. But each slice is essentially the present value of those cash flows today. So we know that we can add them all up. That's what's kind of cool. So what's the area under the curve represent? Well, if we use a DCF, we know that the value of a company is the present value of all future cash flows discounted back for time and uncertainty. I'm going to beat this into the finance literature. It's not time and risk, it's time and uncertainty. All right. So the area under the curve has got to be the enterprise value. Well, I don't know. The first time I kind of figured this out, I thought it was pretty cool. That means I have a visual DCF. The area under the curve is the enterprise value. And that is essentially, I've modeled now a company with a 5-stage DCF. Now let's go play with it just for fun. All right, so here, this is exactly the same chart. I just put it into a line chart just so you could see. On the left, its growth is greater than your discount rate. That flat line is growth is equal to your discount rate. The next line, slightly downward sloping, is growth is less than discount rate. Finally, I have growth at zero, and then at the end, I have growth less than zero, negative, and hyperbolic discounting. That's what it looks like. All right, so here's something that's just for fun is the light blue is your enterprise value with a discount rate of 8%, and the dark blue is your enterprise value with a discount rate of 10%. No change in cash flows, no change in growth rates, no change in duration, just change in discount rate, and you see a decline in value of 17.8%. Well, that to me is really interesting. I've been able to model changes in interest rates very simply. And we all know that when interest rates go up, those cash flows are less valuable. Now, you can play with this. The more the company's growing, the more the cash flows are in the future, the bigger impact you'll have from a declining or increasing interest rate. That the discount rate increases. And we all know that growth stocks are long duration stocks. And we know that when interest rates go up, they get hit more than slower growing companies. All right, I could show you that visually. That's kind of fun. Here's another way of doing it. I did the exact same numbers. I did this on a per share basis because sometimes people think that way. So at the enterprise value at 8%, I modeled to be $26 a share. And guess what? If interest rates go to 10%, then the value of the stock goes to $21.99 and decline of 17.8%. Now, here is the S&P discount rate, just so you could see. Now, we didn't go from 8 to 10, but we did go from 6 to 8.5. And guess what? The stock market was down 20%. So this is what I thought was really cool is if I just increase the discount rate from 6 and change to 8.5, guess what? Market's down 20%, which is exactly how we modeled it before. So this maps to valuation in a cool way. All right, now let's have fun. All right, we know this is the enterprise value. Great. And there's your growth rate. The growth greater than your discount rate, growth equal to your discount rate, less than your discount rate, growth less than zero, and then hyperbolic discounting. So guess what? There's your magnitude, there's your duration, and there's growth. So we've been able now to tie back to our original valuation model, which was, 20 lectures ago, that the big drivers of valuation are what? The magnitude of cash flows, the duration of cash flows, and the growth in cash flows. We've been able to model it. And there's your enterprise value. And we're back to that original, the value of an asset is the duration, magnitude, and growth of the cash flows. And now we've been able to visualize that. I think it's kind of cool. All right, so now let's walk through a couple of examples where I think the model is really fun in terms of visualizing what's going on. All right, so let's say a company beats numbers. They have an upside surprise in their notepad. We model that through, and what you see is that there's an increase in the enterprise value. That's the dark blue is the incremental. So if we have an upside surprise in notepad, no change to growth rates, by the way, no change in duration, just the magnitude is higher than we thought, we'll see an increase in the enterprise value, which is exactly what we know is supposed to happen. Pretty cool. All right, let's just say that all of a sudden people decide that the growth rate's going to be higher for whatever reason. New products getting adopted faster. Well, higher growth rate, guess what? An increase in the enterprise value. Exactly the same. I didn't change the magnitude or the duration. I just increased the growth rate. Well, that fits perfectly. All right, cool. All right, what if you have a lower growth rate? Now I flipped the colors here just to make life simple. Well, a lower growth rate is a decrease in the enterprise value, which makes perfect sense. All right, so I didn't change the magnitude. I just changed the growth rate. That will affect the future magnitude of cash flows. Didn't change the duration, just changed the growth rate. And guess what? Decrease in enterprise value. Exactly what we thought. This, to me, is really the cool one. And this is where I think the whole tool pops, which is, let's say you have a downward surprise to notepad. They miss numbers. Now, management will say, we missed by a nickel. Wall Street, sold off our shares by 30%. Wall Street's incredibly short-term oriented is always the refrain we hear, and the Wall Street Journal loves to write these articles and quote management. We missed by a little bit, and we lost a third of our value. We lost 20% of our value, something like that. Wall Street's so short-term oriented. Actually, it's just the opposite, which is so much fun. Because when you have a shortfall in notepad, you do decrease the enterprise value. But guess what? A downward surprise in notepad is almost always associated with a lower growth rate. Because I'm not really going to give the company credit. They missed. Why would I keep my old growth rate? So we get on a shortfall, you get two things. You get a lower magnitude of cash flows and a lower growth rate. And that's the key. And so you see a dramatic decrease in the enterprise value. It's not that Wall Street is short-term oriented, it's that Wall Street is long-term oriented. That's the key. The valuation mechanism is that's the case. And managements don't get this, so this chart to me is pretty cool. All right, next and sort of final case I walked through, which is, how about this? This is now back to that original chart we had in the competitive advantage article report that Michael and I wrote, which is, guess what? Let's just say that we've modeled the company, 25-year duration, 25-year forecast period, certain amount of growth, certain amount of magnitude. A year passes, and at the end of that year, everyone says, you know what? I think they still have a 25-year forecast period, and I think the growth rate is going to hold. So rather than a fade, we think it's going to hold. Well, guess what? You see a dramatic increase in the enterprise value because now we move forward in time. So essentially, everybody was valuing the company with a certain magnitude, certain growth rate, and a duration of 25 years. At 1 year passes, and everybody says, you know what? I still think that this has got a 25-year competitive advantage period, 25-year forecast period. The magnitude's now higher because the company grew for a year. So we're going to use the old growth rates on the new magnitude, and we increase the value of the company. And in fact, the enterprise value increases by 12% in this model, because what are we doing? We're growing 12% in that first year. So we're picking up that growth. Well, if they do it 2 years in a row, they move forward in time. 2 years later, everyone says, look, we've got a higher magnitude because they beat those numbers. And we're going to use the old growth rate on the new higher numbers. We're going to keep the magnitude's higher. We're going to keep the duration at 25 years. Guess what? We increase again, and you increase the enterprise value by 25%, which is, guess what? 12% compounded for 2 years. So this is how these growth stocks increase in value over time. Now, in a couple of lectures, I'm going to talk about compounders, but this is a compounder. This is the visualization of a compounder where, guess what, is each year we evaluate and say, hey, you know what? We think the company can keep doing it. You know, rather than have a 25-year forecast 2 years ago, we should have had a 26-year forecast, maybe a 27-year forecast. It's that movement in time where the compounder or the company holds its duration of growth for another year, and that's why we get that return, and that's where the return comes from. So the visualization of these cap charts, modern day cap charts, in my mind, are really, I think, illustrate how you want to think about companies and growth, why we get upside surprises, why we get downside surprises, and what the stocks do. Again, that's a visual DCF, and we can use this tool. All right, so a soft catalyst, if you think back to my lecture on market efficiency, I talked about a soft catalyst, is essentially that movement forward in time. And your return, this is a good rule of thumb, by the way, your return approximately equals the cash yield plus the growth rate, assuming a constant PE. That's the key. Well, your constant PE is, guess what? Stable incremental growth and a consistent incremental return on capital, which effectively is the definition of a compounder, which is stable incremental growth. The growth rate holds for another year. The incremental return on capital holds for another year. That's going to keep your PE constant. Having a PE constant is where you get that excess return. So return is approximately equal to the cash yield plus the growth, if you assume that constant PE, which is pretty cool. Another way of thinking about it, your return is approximately 1 over your PE plus your annual growth rate. That's that soft catalyst. And if your PE holds, guess what? You get that cash yield from year 1 plus the growth rate in year 1. Same in year 2, same in year 3. All right, I was thinking about, well, what if you have a company that's growing less than its discount rate? What does that look like? So here's a mature growth cap chart, very similar to what we saw. It's really stage 3, I think it is. Stage 3, where you're growing less than your discount rate, and it just carries forward that way. And then guess what? If that moves forward 1 year in time, I get that excess return. The cap chart moves forward 1 year. My 1 year return is 10.3%. My cash yield in this model was 7.3%. My growth was 3%. All right, so that's effectively what I want to talk about. Modern day cap charts. I think they're pretty cool. They're hard. I don't really use them every day in valuation, but they're really helpful in teaching for sure, explaining what's going on. And I think we can now visualize what a compounder is, which I am going to talk about in a few lectures. All right, we have one more formal lecture after this in the Value of Growth series, and then I'm going to do a couple of examples, a how-to. I'm going to do a private equity. I'm going to do compounders and a historical case on Cap City using the tools. All right, thanks for listening.